Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 8th of October. I'm Daniel Lam, your host for the podcast. Yesterday, we highlighted the rise in oil price as the key risk that can derail the currently constructive backdrop in global risky assets. Let us dig deeper into that today. The conflict in the Middle East has reached its most dangerous level since the beginning of October last year, and Brent oil is up nearly 15% from the September low. Now, historically, central banks have tended to view this sort of oil price increase as a temporary supply shock that does not require a monetary response. And oil prices is still near the bottom of the year-to-date range. But considering the growing confidence that inflation has been tamed and the aggressive easing priced into many rates curves, the surge in oil prices can quickly become an inconvenient truth in global asset markets. So this, combined with the reduction of China-related downside risk and the stronger than expected US economic growth numbers, this can derail the Fed rate cut path that many have been projecting. Now, the markets have already priced in a material easing cycle, with nearly 200 basis points of additional cuts by the end of 2025. And the Fed may require more visible signs of economic deterioration to deliver what the forward curve have priced in. So that means the market may find itself running a little bit too far ahead of the FOMC, and that US rates are due for a squeeze higher as long as a soft landing remains the base case scenario. The US 10-year government bond yield is already challenging the 4% level, and if it hits that level, it may well go to the next resistance at 4.3%. The other point to note is the effect on oil and energy stocks. Now, back in April this year, Iran's missile attack essentially marked the top for oil prices this year. However, the positioning is very different this time around. So even after last week's gains, positioning in Brent and WTI futures is heavily underowned still. So that stands in contrast to the environment ahead of the April 13th attack, when Brent positioning stood at plus 1.3 standard deviation, and investors' portfolio in general had a much more pro-cyclical alignment. Now, at the current positioning levels, oil has historically done quite well. So, when investor positioning is either below the -1 standard deviation or above the +1 standard deviation, forward return distributions are heavily right-tilted. How is that? Well, trend-following strategies, such as CTAs, would likely lead to momentum begetting more CTA buying. So technically, trigger levels for further buying in Brent futures are now at roughly $84 per barrel. So this is especially noteworthy because November and December have historically been strong months of commodity trend following strategies. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.